Oops, sorry about the microphone there. We'll go ahead and start over here. Welcome, everyone, to the Daily Macro Update for Tuesday, January 6th. Taking a look at the headline data here, we can see that there's a divergence between the real market data versus the forward looking data from the bond market as well as the equity markets, the price charts, right? Which is pretty interesting. And so, taking a look at this data for today, we had the logistics sector, right? So, this is the Logistics Managers Index, which is typically a forward looking index, right? So, this is a leading indicator. It's a macro signal because, typically this is, tracking supply chains, as well as, this helps businesses make future, decisions depending on changing demand and all that stuff. And so this is a pretty important leading indicator. And what's interesting about this, when taking a look at the moves over the past really 6 months, you can see that it's had a deceleration from its local peak in February of 2025 and then again in June of 2025. And so, this continues to decline, which typically is a leading indicator that we could see some slowdown within the real economy. But what's interesting is that the bond market, like I mentioned before, and what we'll get to here in a second, is that it's doing the opposite of what it should do if growth is actually slowing. And then also too, we got the U.S. services PMI according to the S&P Global measurement, and that actually continued to decline as well to the lowest print that it's shown since April of 2025. Now it's still above 50, meaning it's in expansionary territory. Anything below 50 is contraction. Um, it is having and echoing what the logistics index was just showing was that is that it's a deceleration in the aggregate economy. And so seeing that along with the S&P 500 now about to make new all-time highs, the market is about to close here in about 8 minutes, right? We're seeing this shift from the Mag 7 stocks into small caps as well as cyclicals like financials, as well as materials, all of which are making huge moves right now. I mean, just take a look at financials and materials, both making new highs, materials being the largest mover, as well as a little bit of healthcare action, right? So, interesting seeing that here today. Um, and then when taking a look at the Mag 7 stocks, specifically the MAGS ETF, that's actually been somewhat muted, you know. Just take a look at this chart compared to something like IWM, which is small caps, two totally different looking charts, right? Mag 7, small caps. Which one has a stronger trend? Obviously, small caps. And so it is interesting seeing that. Also, too, one of the ratios that I like to pay attention to when taking a look at like growth versus value is the IVW ETF as a ratio, um, comparing to the IVE ETF. So growth versus value. And as you can see here, the growth ETF is in a bearish trend versus value. And so, when you zoom out here, you can pretty much see that ever since this large, drawdown during the tariff tantrum last year, growth has been outpacing value by, quite a large margin, right? And so, and if you go back all the way to 2023, by the large part, growth has been outpacing value. Now, there are pockets of times where value does end up gaining strength on it, but the larger trend is that growth continues to accelerate, or, the longer term trend is growth is bullish versus value. But at some point, this will reverse. And what's interesting is that, this is becoming, or growth is becoming bearish versus value. And so this is, part of the thesis of the rotation there. And what's interesting is that when taking a look at something like the 10-year US government bond yield or even the 30-year, these continue higher. And normally, when you have the long end of the curve having an acceleration like this, it is, trying to price in either an acceleration in growth, inflation, or both at the same time. And so, with these going higher, yet the real data is showing a deceleration in growth, it's making you wonder why this is happening. Well, you have to remember that the bond market is a market and yields are inversely correlated to bond prices, meaning that if bond prices go up, yields go down, and vice versa. If bond prices go up, or I'm sorry, bond prices go down, yields go up. And so, right now, with yields going higher, that means demand for this longer duration government debt is actually going down. And yeah, I mean, typically, like I said before, usually that's demand shifting into more of these risk on type of assets, right? And a rejection of safety. But yeah, when taking a look at this though, you have to realize that we're in a position right now, which is a twist in the yield curve. Now, I just made a video about this today, talking about this twist. But what's interesting is that when you have a twist in the bond market, this is when the 10-year and the 2-year go in opposite directions, right? So the long end of the yield curve or the short end of the yield curve, they're going in opposite directions because normally yields go in the same direction, but sometimes in rare cases like we're seeing right now, the curve is going in the opposite direction. And again, this is called a twist. And so when taking a look at the yield curve here, you can see that this is clearly having a steepening effect, right? And when you look at this current phase here, you have the 10-year up over 2% and the 2-year down nearly 4%, right? So they're going in opposite directions. Now, this is technically a bull steepening, which is, typically, bullish for, risk on assets. But because of the context of what's happening right now with the ending of QT and essentially the government, or I'm sorry, the Federal Reserve coming in and being a unnatural buyer of short duration debt, since there's no more money left in the reverse repo facility, this is causing what's called fiscal dominance. All that to say is that we are clearly in an environment of fiscal dominance. My cats are playing over there fighting, so I'm sure you can hear them making some noises there. But yeah, so this is why it's called fake growth because we're actually not seeing consumption rise or real wages rise. We are seeing a large just acceleration in government deficits, which nominally can make GDP look higher, but in a real sense, nobody's actually feeling that way, right? And so what you get is inflation. And you have to remember that there's two types of inflation. You can either have monetary inflation or price inflation. Monetary inflation is when you have an acceleration in the money supply that typically comes first before that translates over into price inflation, which are things that you and I experience when we go to the grocery store, when we buy goods. This is what shows up in the consumer price index, the CPI. And so normally the money supply acceleration, right? So money supply inflation leads price inflation. And that's really what we're seeing right now. We're seeing a large acceleration now in the money supply. And I think you're seeing assets front run that, like consumer discretionary, or I'm sorry, financials, Bitcoin. Bitcoin just went bullish trend in our model yesterday for the first time since September, and as well as Ethereum. So that's a huge move there. XRP having an extremely large acceleration over the past few trading days, and so these are all signals. And yeah, I mean, with the S&P 500 now at all-time highs, right? It's about to close here. You know, it's not surprising. But again, you have to understand something is that when you price the S&P 500 in a hard currency that keeps up with monetary inflation, or it, is a hedge against the devaluing dollar like gold, right? So gold trades like a currency and it's considered hard money still. When you denominate the S&P 500 in gold, man, the S&P 500 looks like a totally different chart. So this is, you can almost think of this as a proxy of the stock market, um, adjusted for inflation. And as you can see, this thing has been in crash mode recession, really since it's really been in a bearish trend since August of 2024. Still, the ratio between the S&P 500 and gold, or the S&P denominated in gold, it has never gone past its peak in January of 2022. You did have a decent acceleration there from May of 2023 to a local peak in February of 2024. But pretty much ever since then, it's been in a bearish trend and really saw a huge crash during the first 2 quarters of last year. You did have a pretty decent bounce from April until it had that dead cat bounce into August. But really, ever since then, once base metals and gold started taking off again because of it pricing in all this monetary inflation, well, the S&P 500 continues lower in that sense. And so, yeah, I mean, as of right now, the S&P 500 priced in gold, adjusted for inflation, is at the depths of the COVID crash, right? And this is a great chart to also represent the way that you and I might feel at the grocery store. It's like, I see online and I see on TV that, there's a quote unquote golden age going on, but I still can't afford anything. Or prices continue to go higher and, it doesn't, even though my stock portfolio might be going up, it really doesn't feel like I'm, much wealthier. In fact, I feel worse off. Well, here's a direct chart showing that, right? So, you have to keep that in mind. Now, instead of getting upset about all this, let's just take some responsibility for our own actions reacting to something like this and be able to have a strategy in order to invest strategically in order to combat this, because that's really all we can do, right? And that's what the macro data does for us here at Macro Optics, is that it allows us to look at which assets are in bullish trend and own those assets, right? It's a guide to which things to own given the macro environment. And yeah, I mean, if you just go back in the past videos over the past few months, I mean, we've been talking about silver, we've been talking about gold, platinum, all these things that have been having huge moves. And it's because of this fiscal dominance dynamic, right? I mean, just look at this move in platinum. It's totally ridiculous. And yeah, let's take a look at the S&P 500 in terms of platinum. Let me see how that chart looks like here. Okay, let's see. Man, that looks really bad. In terms of platinum, the S&P 500 is looking like a rug pulled cryptocurrency. So, yeah, I mean, this is all just evidence of this fiscal dominance breakdown, and we're being sold an illusion nominally of higher asset prices when it's really just a complete devaluation of our fiscal, our fiat currency, which is the dollar, because of this absurd um, government spending and the Fed injecting liquidity into it, which is why, I think Bitcoin and some of these risk on assets are going to continue higher from here. And it's not a great thing, you know, that in real terms, like for people who aren't investing in the markets, like I feel bad for those people because they're doing nothing in order to combat against these crazy central planners. But you're here now, you're listening to this, and I'm sure you've heard this from other people. But that's the whole reason to invest. It's to make sure that your money is combating the erosion from the people in government. But let's go ahead and go into some of the questions here. I appreciate everyone for joining. All right. We got a pretty decent viewing here. Let's take a look. Appreciate all the likes and the shares. What do you guys think about Bitcoin? Thoughts on open? Let me see. Appreciate the comment. Open door. Uh, I don't really know too much about this company. It looks like it's had a pretty wild ride over the past 6 months to 9 months here. Had a very large acceleration from June, and then it kind of just stopped in September. So I had a pretty crazy 3 month run, and it's looking like now it's just been consolidating here. So, something like this, I would like to see a little bit more of a breakout, and then a quick drop down to the low of the trading range on lower volume. So I would still give this a little bit of time just to see if it's able to continue higher, so that it's not just doing one of these, right, where it zips up and then continues down lower. You don't want to get trapped in that. So yeah, with something like Open Door, I'd probably just give it a little bit more time. It is in the real estate sector, and when we take a look at real estate with the ETF XLRE, this is a sector right now that is in a neutral to bearish trend. So I mean, it's not something that is on the top of my list to buy right now. So, but good question though. Okay. I want to see how Bitcoin acts at 100K. Yeah, I mean that'll probably be a big even level. We'll see what happens, but I mean, yeah, I think it could continue higher from here. So, um, at the timing of this recording, Bitcoin is trading at 92,400. So, from here up to 100K, that'd be about an 8% move. So, we'll see though. It's having a lot of positive trends right now. But yeah, that's currently my thoughts here on the market. It's a very interesting time right now. And, typically with fiscal dominance, um, you could see like a short term move in a lot of these liquidity assets. But in the medium term as well as long term, fiscal dominance doesn't end well. Meaning that in a lot of cases, you end up getting hyperinflation of the currency. And then you have some type of huge regime change, socially. If you look in past history, this is typically what causes like revolutions and all this stuff. Not saying that's going to happen. You could just have like a peaceful change in power, or just like another Bretton Woods agreement. But yeah, we are definitely in the later stages here of this much larger cycle. So again, can't really do anything about it. It's out of our control. But what we can control is our asset selection and how we manage our portfolios. And so that's what we are here to do. But with that, we'll go ahead and end it there. I appreciate everyone for joining here. Oh, sorry. I had a couple more questions come in. Is Tesla a good buy? Tesla has been losing strength. So this is not at the top of my buy list. There are definitely other things. Any thoughts on base metals fund DBB? Yeah, it's in bullish trend. Just had a huge acceleration. Um, yeah, not doing anything with that except for selling it if you have some. Not financial advice, but you don't want to chase this, right? It's already gone up a lot, especially with it blowing past the top end of the trading range. This isn't a time to This isn't a time to just FOMO in, right? If you missed it, you missed it. Look for other opportunities. You like Bitcoin miners now that Bitcoin is bullish? Yeah. Well, the only problem with the Bitcoin miner stock WGM or the Bitcoin mining ETF WGMI is that in the holdings of this ETF, you also have some AI stocks which haven't been performing as well, and so it's kind of been dragging that down a little bit. But yeah, I mean, you could see a pop off. That is a good sign that Bitcoin is back to bullish trend. But just because Bitcoin is back at bullish trend doesn't mean that I'm going to start just blindly buying, Bitcoin miners. So it might be a hint to start to think about getting ready to do that potentially if they do reclaim bullish trend. But at the timing of this recording, at least, could change. It could change pretty quickly. Who knows? But at the timing of this recording here, Bitcoin miners remain in a bearish trend for now. So good question though. But all right. Okay, we're gonna go ahead and end it there. I appreciate everyone for joining. I hope you have a fantastic rest of your Tuesday, and we will catch you back here tomorrow at 3:45 p.m. Eastern time for the market close for the daily macro update. Bye, everyone.